Hi, and welcome to the Mortgage View. I'm your host, Karen Grafton from Atlantic Coast Mortgage, and today we have with us the best originators in Virginia. They're knowledgeable and they're experienced, and we're going to bust the mortgage myth. So, common mortgage myths today, we're going to bust them. And as a thank you, we would like to offer our viewers a Starbucks coffee. You can use the QR code on the screen and enjoy a drink on us. So thank you guys for joining us today. And the first mortgage myth that we have is it's going to you, Lisa. You should always choose the loan with the lowest interest rate. Can you bust that mortgage myth? Tell us why.
Sure, Karen. Hi, I'm Lisa Nichols. I serve the greater DMV, Carolinas, and Florida. And busting the myth on always going with the loan with the lowest mortgage rate is just not true. We just had a real life example of this where we were competing with another local agency in the greater Northern Virginia area. And the client said, well, I got a rate of 4.99 and that's what they said. And so I'm just going to stay with them. I'm going to go with them. And we said, well, how many points are they charging you to get that rate? And the client, the woman said, I just really don't know if they're charging me points or not. They didn't review any of that or the numbers with me. They just gave me a rate. And I said, well, can you get a copy of your loan estimate and send it over to me? And she said, sure. And I had it in about an hour. And the lender was charging 3 1/8 points to get that rate. Now you can just do the simple math on a $400,000 mortgage. That's a lot of extra closing costs in just the discount points.
Yeah, it's like 13.
In addition to all the standard costs. And when you look at the sheer math of it against a par rate and the recovery time it would take, it just didn't make any sense. So just the sheer math and having the detailed conversation with the client, we won her over pretty quickly.
That's awesome. Does anybody else have any examples that are similar to Lisa's about comparing apples to apples?
Yes, I had one with the builder where I almost lost the deal because they were quoted a cheaper interest rate. And like Lisa did, I went ahead and had them send me the loan estimate. They totally had a different loan product. They had actually had a lower loan amount. They were doing a piggyback second with this client, whereas I was doing one loan, 10% down, no mortgage insurance. They didn't even disclose the payments of the second trust. They put it all as a lump sum that what they did was completely unethical. I was able to point it out, and the client did end up staying with Atlantic Coast.
Wow. All right. Well, myth busted right there. You got to compare apples to apples and have a trusted lender that you trust to look over the numbers and to show you that math. Katie, if you want to buy a house, your credit score needs to be excellent.
Thank you. So I'm Katie Brinson, and I am in the Virginia and North Carolina market, and that is actually not true. Everybody is human. Everybody has speed bumps and dings on their credit. To use most of the first-time buying programs, you actually only need a 620. And if you're using Credit Karma, I need you to put it in the trash. The only scores that matter are FICO versions 4, 5, and 2. And the only thing that means to consumers is that you can access that with the MyFICO app or myfico.com. Any other score you see from Equifax or banking, anything like that, it is not relevant at all to the mortgage world. And if you're not sure how to proceed, just contact a loan officer, or you can call me directly.
Yeah, absolutely. Anybody else have some credit stories they want to share? People thinking that they needed to have perfect credit before purchasing a home?
One thing, friend.
Yeah.
I will add that a lot of people think that if you've had a derogatory event like a short sale or a bankruptcy or a foreclosure, that you can't buy again, or that the waiting period is 7 to 10 years, and it's not true. With many programs, you can purchase again after 2 years from a bankruptcy, and depending on the loan program, it can be as few as 3 years for a short sale.
Wow. That's awesome.
And I just like to say too that just because you have one or a couple dings and your credit score isn't perfect doesn't mean that we can't find several or many suitable options for you to enter into the home buying market. Also, we have options to help you improve your FICO score at Atlantic Coast, especially in the new build world where we have time to really improve that score, there's things that we can do on our end that could give you a more desirable outcome on the rear end closer to closing. So we're here to help. All of us are here to help and offer you the very best solutions that are out there.
She said that she would help you with your rear end. I heard it here first, people. I'm just kidding. Melissa, tell me, you should find, here's a myth. You should find a house you want and then apply for a loan. Is that a good idea? Is that
It's a horrible idea. As I was
Why?
saying earlier, I had someone that found their dream home over the weekend and had not applied. Their agent sent them over to me. And guess what? We have a 580, a recent bankruptcy. They had they should not have been looking at homes. We now have them on a plan, but they wasted their time, the seller's time, and their agent's time by going to look at homes that they were not qualified to purchase. So it's good to get.
That actually brings up my next myth, which is you should buy a home for the maximum mortgage you can qualify for.
No, not at all, because things happen throughout your life. And also here in Northern Virginia, tax bills were just released. So your taxes will likely go up. My homeowner's insurance went up this year just due to all the natural catastrophes. So I like to be able to travel myself. And I want to allow more money to spend on things that I like to do and not be house poor and plan for the future as well. So no, you don't need to purchase your maximum price point.
Yeah, absolutely. And I mean, just as like a sort of a number out there, I mean, a lot of times you can qualify for a mortgage up to, or total debt, your mortgage plus your house, student loans and that kind of, to close to 50 gross income. So look at some people's incomes be a very rich, and so I agree with you. Anybody else want to that you should buy a home for the maximum mortgage you qualify for? Have any advice there? What about you, Jenna, in Charlottesville?
Thank you, Karen. This is Jenna from Virginia, serving Charlottesville, Virginia, and all the surrounding areas. But no, I actually, one of the very first conversations, or the very first conversation that I have with my clients is, what is your goal payment? Because what you qualify for is a lot of times a lot higher than their goal. I just had someone this past weekend, similar situation. They went to look at their dream home. We went over the numbers and they were a good $1,500 off a month for their payment. They could afford it. And we were able to kind of work a good plan that they were comfortable at. But sticking to goals is really important, I think, for me and my team, for our clients, so that they are not house poor and they can build that equity to then go to the next home. So yeah, I don't think that people should max out at all.
That's awesome. Jolene, actually, here's another myth that kind of following what Jenna says. Don't buy until you find your dream home. Is that a myth that you can bust?
That's a definite myth. I'm still not in my dream home because like Melissa, I like to travel. So here's the thing, start building equity, start building wealth. You can always move up. You're not creating wealth by renting. Make sure, like Jenna said, that you're comfortable with the payment. That's a conversation that I also have. I always give them their qualifying number and comfort level number. But, dream home will come. Again, I'd rather take dream vacations. I want to just live in a house that's going to meet my family's needs, and I won't flip out if the taxes or insurance go up.
Right. Yeah, absolutely. Katie, you want to chime in on there? I know you work with a lot of first-time home buyers.
I do, and sometimes there's this difficult conversation of what they want versus what they can afford, and HGTV is to blame for a lot of that. So you're not allowed to watch HGTV if you are shopping while I am your loan officer. And so we have to look at the long-term generational wealth and the baby steps that it takes to get there, right? Jay-Z didn't get to where he is overnight, and it's the same process when you are trying to get to your dream home. You have to start somewhere. And plus, that's a great way to build out your investment portfolio. Start small, buy your next house, and turn your first house into an investment property.
Most financial planners say that wealth is built by real estate, not 401k and retirement plans. So,
wow. Well, that actually brings me to another point. I mean, Lisa, and here's another myth for you. It's cheaper to rent than own. What do you say to that?
I say that definitely can be a really significant myth. Depending on what your goals and strategies are, If you're just in an area for 9 months or 12 months, then maybe renting is a great option. But honestly, financial wealth building has real estate as one of its cornerstones. And like Jolene said, like Katie said, and when you're looking to build your financial wealth over time, real estate is a real significant piece of it. And if you look over the past 4 or 5 years across the country, tremendous equity has evolved and developed in most pockets of the country in terms of home ownership. And so houses are worth a lot more now than they were several years ago. So that would be a really, really good reason to have home ownership. And in certain markets, the rent is just simply more than the mortgage payment would be if you had an average or even a larger down payment. So it's definitely a myth that renting is always better than owning, because you want to build your financial wealth. Sometimes you just want the pride of home ownership, and sometimes you want to renovate the kitchen or add a pool or add a privacy fence. And if you own the home, you can do all of those things. If you rent, you can't do any of those things.
Absolutely. Any other advice from our folks that want to chime in? We also ask for the audience, if you have some myths that you want busted, we can go ahead and add them into the chat, and we will make sure that those questions get answered as well.
One thing I would like to circle on, Lisa, is on the rent versus owning. What I've been hearing from a lot of clients, and I deal with, like Katie, a lot of first-time home buyers, rents are on the rise as well. So at least have control over it. Get a payment locked down. Even if the taxes and insurance go up, you know what you're into. But I couldn't believe I had a client recently that their rent went up $600 a month in the Fredericksburg area. I mean, that's huge. That's, really explore your options. A lot of mortgage payments right now are the same as renting. And with a lot of the different programs out there, you can get in with limited funds. I mean, sometimes if you're a veteran, it's cheaper than putting up security deposits and first month's rent.
Yeah, absolutely. I've noticed that some young people will even, purchase a home and rent out a few rooms in the home to, offset the mortgage and start their financial plan. Absolutely. All right, let's talk a little bit about the mortgage process and some myths in that. Jolene, you should always go with a 30-year fix. Can you bust that myth? What are the circumstances?
Not necessarily. So one of the things, I'm just not an application taker. I have a very detailed conversation with my client after they fill out an application, or even before that. This is a very transient area. ARMs are coming back. Everyone's afraid of ARMs because of what happened in 2008. These are not the ARM products of 2008. I mean, I personally have done ARMs myself, 5-year ARM, 7-year ARM. And
what makes it different, Jolene, from those ARM products versus these? What would you say?
Oh, the biggest thing is these products are more stable. I mean, the term's longer. It's either a 5-year or a 7-year product, where those other ARM products, they had pay option ARMs that adjusted monthly. They also had ARMs that were around for 2 years. And then, people didn't have the time to, accumulate enough equity to do a refinance. These other ones are creating longevity, where your chances are, I mean, I don't have a crystal ball, but chances are with these ARM products, you're going to be able to take advantage of refinancing when rates come back down. They always come in ebbs and flows.
Absolutely. And I know, I was in the mortgage market at that time as well, and people were doing interest only loans, where you only pay the minimum interest payment. You weren't building equity. And they were also not putting any money down. So at the same time, did you see that as well?
Yes, I did. That's good. And the other thing with those ARM products is they were also doing on people with 580 credit scores. So thank you for bringing that up. So that's the reason we had the market collapse. The market right now is nothing like the market of 2008. And I think, we've been into this for a year, where things are, the rates are starting to go back to where they have always really been. And you're not seeing the foreclosures. People are still able to make their payments.
Right. Yeah. Melissa, what do you think about that?
I just want to add to Jolene really quick.
Yeah.
Jolene does such a phenomenal job of the journey and the exploration with the client. And at Atlantic Coast, I think a lot of us take tremendous pride and care and love in everything we do with our clients. We really want to create a relationship when we're serving with them to really go deep and find out what their goals are for the journey, what their needs are, so that we can best serve them and offer them the plans, programs, products that best serve their goals.
Absolutely. Everybody is a different situation with a different set of goals, and there seems to be a loan program that fits each box, So, Melissa, what do you feel like with the 30-year fixed? Do you think you should always go with a 30-year fixed?
No, I'm going to agree with Jolene on this one, that everybody's situation is different. Sometimes, like myself, when I refinanced, I went to a 15-year, and that is just because I was in a position, rates were at their lowest. But I think once we gain what their desire is, then we can probably get a better idea of what products would be better for them. Like Jolene said, the 5-year, the 7-year, even the 10-year ARMs, they're much more stable than the interest only, or as I like to call them, the credit card payment loans that were a thing of the past, which was probably the biggest reason for the downfall back in 07 and 08.
Absolutely. All right, so we have a couple of myths just in live from our viewers. Let's see. What are some of the first-time homebuyer programs to help with down payment and closing costs? So I would say the myth is there's no first-time homebuyer programs, and then busting that myth is there are, and what are they? Let's go with Jenna. I know you know a lot about this.
Yes, yeah. There are a ton of grants, programs that cover from closing costs to the down payments. I would say that a majority of our clients actually buy a home with little to nothing out of pocket. Just like someone had mentioned earlier, renting a home, you have to usually have a security deposit. And our first-time home buyers that qualify a lot of times get into these homes with nothing out of pocket, very little if needed, much smaller than a security deposit. That's actually one of the things that we do really well here. We go looking for these grants. We just don't wait for a client to ask if it's available. We go looking for those, and we're constantly searching for new ones, and we will stack them on top of each other to provide as much as we can, whether it's buying the rates down, covering closing costs, covering down payments, all of those we'll find.
Yeah, absolutely. Jolene, I know you do a lot with, well, all of you guys do actually, but Jolene,
Right.
with the Virginia Housing and Development Authority, can you speak to that?
Excellent. Absolutely. So the Virginia Housing is awesome. How their grant money works, though, it's either used towards down payment or closing costs. However, a new grant just came out, and only certain mortgage companies are allocated funds for that grant. We are one of those mortgage companies. Those are, those have their separate set of household income. I know Karen touched base on buying a house earlier, renting out rooms. With the grant money, you don't want to do that because they base it off of household income. So don't. If you do it a year later, whatever, you're fine. But if you're having roommates that are moving in with you at that time, that will have to get counted. The big thing with those is it's very important when you're utilizing those programs that you know what county that you're looking in, because the grant money can change. The income limits change depending on the county. And I have seen people get caught with that. Clients that have come to me that have not communicated that well with other lenders, and then they're left unable to utilize the program. So that's one of the things in my fact-finding call that I have. So one other thing I want to back on that Jenna said is the Virginia Housing Grant, as I was saying, is either or, but then this federal home loan grant, you can actually stack that on top of it. And we've been very successful in buying down the rate for our clients with that grant.
That's awesome. And that actually goes to my next myth that I wanted to bring up. And Katie, maybe you could answer this, that all lenders are the same, because I've noticed that is a huge myth. Tell us why.
Yes, there's so many different reasons. Well, the first thing is that not all lenders have access to these programs, as the ladies were mentioning. So for example, brokers and larger lenders are not eligible to offer Virginia housing programs. And so I had a client last week that came to me. She's a single mom, and she's been working 3 jobs, and all the money she has is all the money she has. And she was pre-approved with another lender, and they didn't offer any of these programs, and they wanted her to wipe out her entire savings to get into a home. And she was hysterical because she got under contract and they hadn't gone over the cash to close. And when she got her loan estimate, it was like $4 less than what she had in her bank account. So the rate doesn't matter if you're not in the right program, which is why not all lenders are the same. So we were able to get her into Virginia Housing. She's not putting any money down. Her closing costs are covered by the seller. She's going to get her earnest money deposit back. And so the loan officer is the quarterback of the entire loan. And they need to know what program you are eligible for, and they have to design a mortgage around you. They should be customizing the mortgage around the client, and that's something we do really well here. But again, not every lender is the same, and a lot of them just have the cookie cutter options.
Right. Yeah, whether it be the company or even the loan officer, to know of all the products available to you and if you qualify for them based on your income and where you live, and if you know how much you make, all those things. Does anybody else want to talk about any of the other first-time homebuyer programs? All right, next myth coming in. I've got a myth. Do you as a loan officer control the rates? Let's give this hard one to Melissa.
I wish that we did, because we would still be sitting at 2.5% rates, but no, we do not.
Yeah, how much control does one lender, have over, like, how does it all work, I should say? What should people be wary of?
Well, the mortgage-backed securities, the 10-year treasury, there's a lot that goes into it. The economy as a whole, inflation is playing a major part in our market right now. Yesterday was kind of a crazy day for all of us, and I don't like to use the word crazy, but Home Depot and Walmart announced that their outlooks were a little bit grim for the year, and that played a role in the market. That's kind of, but no, I wish we did play. We had control of the rates.
You would make them 2.5. I like that.
Yeah, I do.
We'd all be coming for you. Katie, do you want to comment on this as well?
Yeah, especially with the state program. So a lot of clients say, well, I've been told I need to shop lenders, and cool, that's great. But if you're using a state program, the rate is the rate. Every single day, Virginia Housing puts out its own rate sheets, and each lender gets that rate sheet. The lender and the loan officer have no control over that. If you want to use the program, you use the rate on the sheet the day that you are locking. And so you can fuss at the loan officer all you like, but unfortunately, if we could do it like Melissa said, we do it at 0%. We just want to help you, but we don't have any option to do other than what is on that sheet.
0%. That's a better quote than Melissa just gave. So.
Gosh, I know.
We go with Katie.
It's getting lower and lower with you ladies. I have a question from Darlene. Can I roll my closing costs into my loan? That's a great question. And I'm assuming, let's start with a purchase. Can you roll your closing costs into your loan on a purchase? Jenna?
Well, I would say the majority of people cannot roll in closing costs, although there is USDA, which does allow you to roll in closing costs if your appraisal comes in higher than the purchase price, and of course you still qualify. So there are some programs that allow it, and there are other ways that you could work that to get the seller to cover the closing cost, but you, for the most part, cannot roll your closing cost into your loan.
Melissa, can you roll your closing costs where you live?
I cannot. That would be great if we could, but no, you cannot.
What about on a refinance, and how does that work?
On a refinance, yes, you can. You just stack it on top of what your payoff is on your current mortgage, as long as you have the equity in your home to sustain those closing costs.
Yeah, absolutely. What do you think? Do you have anything to add, Jolene? What would you do if somebody needed closing cost help in this market?
Well, hopefully they'd qualify for one of the grants, but if not, USDA, like Jenna said, is the main one. And again, the house has to appraise for higher, or, ask the seller to pay it. But
Right.
That would be the way that I would structure that particular deal.
That's good advice. All right. Again, about the process. If Melissa, if you're pre-approved for a mortgage, can you automatically get a loan? How does that work? Like, what are the different stages. Can you bust that myth?
Well, so the answer is no. I actually have a case in point. We had a buyer that was approved, everything looked great. And when we go to pull Cavers, he has a student loan that he hasn't paid in quite some time. I'm going to say at least 15 years. When he called to get the payoff amount, it was $72,000. So, and we were doing a 3.5% down FHA loan. So what we were able to do was delay closing a bit, let him set up a payment arrangement. But I mean, he was able to finally close with a later settlement. There's also times when there's undisclosed debt. People don't realize that we do check and verify. They maybe they have alimony that they didn't disclose to us originally, or they open up a new credit card or go out and get a new car. A lot of things right now may sound kind of bizarre, but people have had to order their cars, right? To get a new one, it may take months. We have one right now where that their new pickup truck came in, and they now have a payment that we hadn't planned on. But with this particular buyer, we do have a little bit of room, but we do find out things, and that's a lot of times what will happen with not being able to automatically get a loan once you're pre-approved. And another one is the loss of a job.
Right. Yeah, that's a nightmare situation, but you're right. Jolene, did you want to comment on this?
I would. People are so excited, rightfully so, when they're buying their first home, or any home for that matter, even though if it's not your dream home. But I have people that start ahead of the game. They'll hit President's Weekend, so they'll be out furniture shopping. I've literally had furniture salesmen lie to my clients. I had one recently where they told them, the furniture salesman told them he used to be a mortgage loan officer, and because they were getting 90 days same as cash, that they would be fine. The client, as I encourage all of my clients, if it's urgent, they called me. I answered on a weekend, which all of us are available, and walked him through it. And then the guy was right there. They actually put me on the phone with the gentleman. So needless to say, they didn't buy the furniture. But that's, people will always listen. If you're buying a house, it's great that you have parents that are looking out for you, but I can tell you, listen, talk to the mortgage professionals. This is what we do day in and day out. Guidelines change. We're going to be your source of information. Don't listen to anyone else. The other thing I would get was, well, my neighbor got a loan for this amount. We don't know what your neighbor's, debt ratio is or anything. Again, that goes back to comparing apples and apples. But sorry, I just went on a tangent there.
No, I love that. I love that you're lurking around, don't be buying, this furniture.
We have it on our emails.
Yes.
So
that's
we
awesome.
have it on our emails. Mm-hmm.
I've had many of call from a client at some purchase that they want to make, after they go under contract, and I always love that they reach out and ask for your advice. Jenna, did you want to add something?
Yeah, I just wanted to add that one thing that we do really well here too is educate and encourage our buyers to call us before you sign the contract, because just because we have pre-approved you, we find a lot of our buyers are looking in subdivisions that may have very large homeowners association dues, and that becomes a factor that could then turn your loan ratios into a negative where you were, looking good. Plus, I want to be able to have that conversation with them on what that looks like every month, and is that something that you're comfortable with? So you can definitely take a pre-approval to not with something as simple as just homeowners association dues.
Yeah, absolutely. I mean, and working with someone, if you're comparing, let's say, condo to a townhouse, and you're going close to your max, and then you end up with a high condo or HOA fee. That makes sense. We have another question from Brandon Harris. Does certain debt weigh heavier than others? Katie, can you take this one?
Yeah, absolutely. So we actually look at the monthly payments. A lot of my clients, when I'm on the phone doing a consultation, they want to tell me their balances. And that is definitely important. But debt to income ratio is actually based on your monthly payment. And for your credit cards in particular, we're looking at your minimum monthly payment as reported on your credit report. So I would say the debt that weighs the most is the one with the largest monthly payment, because that is the one that is removing your most buying power.
Yeah, that's awesome. I know. Well, while I have you, Katie's an expert in a lot of things, and credit is one of them. You also work with a lot of self-employed folks. And if you can bust this myth, I'd love it. Being self-employed makes it hard to obtain financing. Is that true?
No, I love self-employed people. If you have 8 tax returns and an IRS debt repayment plan, you are my people. No, it's not true. So the most common thing I hear is, oh, well, I write off too much to qualify. And maybe you do, right? If you write off a $14,000 cruise because you had 30 minutes of continuing education at the bar, that's probably an issue. But if you're a regular business owner and you have yourself on payroll, or if you are profitable and you owe the IRS money at the end of the year, then there's a solid chance that not only could you qualify for a home if the rest of your debt situation is reasonable, but we can even pair you with a first-time buyer program. A lot of people think, well, I'm self-employed, I can't get a grant. And that is definitely not true. I am self-employed and I don't have myself on W-2. Well, if you're Schedule C, you're not going to have a W-2 most of the time. You're going to take an owner's draw. We look at cash flow. So we're looking at the overall big picture of your business. And that's why you have to have a loan officer that understands, how does your business operate? What is your cyclical cash flow? Are you seasonal? What is your primary source of income? For example, are you business to business? Are you business to consumer? Especially with COVID, because so many of those guidelines changed, and it just absolutely terrified business owners to even try to finance. And so, another example I have is depreciation. Well, you can write that off on your tax returns, but you don't write a check for depreciation. So we're going to add that back to your bottom line. For our real estate agents, they drive 8 million miles a year and they write off their mileage. A portion of that is depreciation. And there's a calculation, I think it's like 61 cents per mile. We multiply that and we add that back to your bottom line, business use of home. That's not an actual expense, but the IRS allows you to take it. So there's a lot of nuances to it that it's really important to be paired with a loan officer that understands.
Yeah, absolutely. Anybody else want to tackle self-employment?
Everything Katie hit it spot on.
Yes.
Yeah.
Spot on, Katie. Great job.
Yep. So one more myth I've got here. Well, actually, we have just in from Nicole Greco-Faust III. I was told because I have student loan debt, I won't be able to buy a home until I pay it off. Is that true?
Do you want me to take that one?
I was gonna go to Melissa just because that was.
Well, so sorry. Here I am.
Go ahead, Melissa.
I was going to let Jolene take it, but that's okay.
Oh.
So no, you don't have to pay off your student loan debt. It may decrease what you're qualified for, but no, you do not have to. And she's over here fanning herself now. No, you do not have to pay off your debt in order to qualify for a purchase.
What is it, Jolene? Do you want to chime in? What is the deal with student loan debt?
Well, the deal is a lot of people are still in that forbearance, right? So if there's not a monthly payment that they've been paying, certain programs require different calculations. Most people, though, prior to the forbearance were on what was called an income-based repayment. That's the best option. I'll have my clients that have student loan debt contact their student loan servicing company just to validate that once it comes out of forbearance that they're still on that program. As long as the payment isn't zero. I mean, it can be as little as $10 a month, then we can use $10 a month. We just can't use zero. And then we have to use a certain percentage depending on the loan program. And that makes a big difference.
Wow, you ladies are amazing. You know all the tricks of the trade. Last Mythbuster, it's cheaper to buy a fixer-upper. Lisa. Is it cheaper to buy a fixer-upper right now? I mean, there's a lot of homes that are on the market that need some work. Is it cheaper to buy a fixer-upper, or is it better to look at you can't hear me? Am I muted?
Lisa is.
Oh,
I can
Lisa,
hear
you're
you.
muted. I'm sorry. Lisa,
I'm sorry, not sure what happened. Can you hear me?
Yeah,
Yep.
now I can hear you.
So buying a fixer-upper can be a great deal if you know what to look for and you have a good eye as you're going through the house. Fixer-uppers, of course, need work, whether it's on the inside, the roof, the structure, the outside, the siding, new kitchen. And so it can be a good opportunity, but it also can present a scenario where there are hidden and unforeseen costs if you don't do your due diligence when you're looking at the house. And I have a real life example of this. A family member bought an auction property in the greater Fredericksburg area and thought that they had received a really great deal on it, only to find out that as they got into the property and started with the GC, the basement had what I'll term as faux walls. And what was behind the walls was dirt. And so it created a whole subset of costs in terms of foundation, walls, creating the basement, actually, load bearing issues for the upper floors. And so buyer beware if you're looking at a fixer-upper, and make sure you have a highly experienced person with you, a general contractor, a handyman, a home inspector, somebody who can look through the property and really give you a breakdown of estimated costs about what you're fixing up.
Yeah, absolutely. I mean, it definitely comes down to the money. Buying a home that's worth, another 50,000 to get you into more what you want for the after product, could be like another $250 a month versus the whole rigmarole of, trying to do it yourself. So anybody else want to add to that? Have any advice?
Yeah, Karen, I was going to say that we do here at Atlantic Coast Mortgage have these amazing rehab loans, and they've been very popular in my area because people are looking at these fixer-uppers, but maybe they don't have the money to do it. So we work very closely with the buyer's agent. We do a lot of upfront work to see what does this house need between home inspectors, contractors, whether it be 1 or 5. And we build this package of a rehab loan that essentially can turn an ugly home into a beautiful home, but it really takes an army of people to support that buyer. And again, us as your lender and your agent working closely with the contractor to figure out what those hidden things are, so they're not, turning up like Lisa's client. There probably always be things, but it's certainly education up front and kind of going over the pros and cons. But the rehab loan has been amazing at keeping people's money in their pocket and being able to finance it.
Yeah, I love that. And that's another example of a product to fit a need. So everyone's situation is different, and depending on what you've got, working with the loan officer that knows these products and the difference and how to really solve your come up with a solution for your problem. Katie, do you want to add something to that?
Yes, really, really important. Every loan type has a corresponding appraisal, and each appraisal has very specific property condition guidelines. And so if you get a fixer-upper and it has peeling paint or rotting wood, and you're using a government-backed loan like VA or FHA, the seller is probably going to have to fix that before you can even buy it. So you may be willing to take on the work, but depending on the loan product that you're utilizing, some of that won't fly, and it has to be taken care of before closing. So you have to work with a loan officer and a real estate agent that understand the specific property condition requirements for each individual loan type, because if you're willing to take something on and the seller isn't, there might be a gap of understanding there when it comes to the appraisal. Also, I think we all agree, buy the ugly duckling on the block, right? Hot pink tile, green toilets, purple kitchen, but really solid structurally and okay on the outside. That is really where you're going to build the most wealth the fastest.
Yeah, I like that. Awesome. Well, we're running out of time, guys. Thank you, Jolene, Katie, Jenna, Melissa, and Lisa. Just a wealth of knowledge on this call. Thank you for busting the common mortgage myths. Great job, guys. Have an awesome week.